Manishi Raychaudhuri joins us. Manishi, what is causing this kind of a panic? Is it pure technical adjustment in the market?
Nikunj, good to be here. Thanks a lot for inviting me. Um, I think it's got several factors, both local and global, playing together. So on the one hand, we have this concern about rate hikes by the Fed and the concerns about inflation, which obviously has ignited the worry that the rate hikes and quantitative tightening would possibly come over at a faster pace than we had earlier anticipated. And second, we're also seeing this possibility of local sort of contagion, and the concerns about overvaluation in India compared to the peers. So I think these are the two or three things that have combined together to lead to this correction. I would also point out that this is not an India specific issue. Across Asia we have seen this, and MSCI Asia ex Japan itself has corrected about 2 to 3%. Though of late, over the past 1 week or so, India has underperformed.
When do you see that we could be nearing this painful gut-wrenching fall? Are we nearing the end of this decline?
These calls are very difficult to take, as always. Because in times like these, when you have a very sharp correction, and particularly those sectors and those stocks which were overvalued, which didn't have valuation support, very often we see there's a degree of overshooting and undershooting. So we had possibly seen the overshooting phase earlier in late 2021. We might see a degree of undershooting below the justifiable valuations now. Now, having said that, I would also like to argue that for the longer term investor who likes to focus on earnings estimates, things are not really looking that bad. I was looking at the consensus earnings estimates. They have actually increased for some of the sectors that are heavily represented in the Indian market. Earnings estimates have increased for financials, for IT services, for consumer discretionaries, even some of the auto companies, which are still facing the brunt of the supply chain disruptions. So I think analysts and investors are beginning to take the call that the economic cycle is possibly just about starting. It's difficult to prognosticate. It's difficult to predict how long this short-term correction would last. But for a longer-term investors, certain sectors, certain stocks within the market are beginning to look attractive.
Good morning. This is Nantara. So as we figure out the stocks which may be more overvalued, those that still have a long road towards profitability, Manishi, how is one supposed to make sense of this kind of a sell-off when the markets even stop reacting to earnings, from a Reliance Industries to an ICICI to even Axis Bank? What would be the big message out there?
We have seen this playbook before. When you have a big global concern, some kind of a sword hanging over, over your head, which is essentially the liquidity retraction by the Fed, which is almost certain to come now. This kind of a market reaction has happened, and it'll continue to happen in future. I mean, there's no getting away from this. Having said this, I must also point out that there are some silver linings. We have seen the Asian currencies, particularly those in China, in Southeast Asia, and in India, remaining relatively stable, unhurt by this expectation of a very sharp retraction of liquidity by the Fed. That's clearly a positive, and it's a bit of a departure from the previous rate hike and liquidity retraction episodes that we had seen from the Fed. Earnings estimates going up, that's something I'd earlier talked about. And if one looks at some of the other variables like credit growth picking up, it is just about beginning to happen. Um, so I don't think all is lost for the Indian equity market. In fact, we still have a constructive stance on Indian equities. We are overweight in our Asian model portfolio. We have a target of 62,000 by the end of 2022 for the Sensex. But it's, this volatility in the short term is something that we will have to grin and bear. In particular, the kind of sectors that you guys talked about earlier, the tech companies, the platform internet companies, which were overvalued to start with. These are technically called the long duration equities, where much of the present value of the company is actually in the terminal value. These are the ones that suffer the most when we have an anticipation of cost of equity going up. These are the ones that don't have valuation support. And unfortunately, that's something that's it's something that we have to tolerate for now. There's no getting away from it.
You did have a Sensex target for 62,000, which at the start of the year looked like we would achieve it very, very soon. But now, as we can see what is playing out, for all of our viewers as well, they're saying that there's a global sell-off. That's why, the fundamentals at play are not even at play at the moment, like earnings. But this is a very different India from the great financial crisis. So when we do see the unwinding, do you think the blow will be far less? The equity markets will be more shielded than we have seen in the past when rate hikes go up, when quantitative easing is wound up?
Undoubtedly. In fact, we feel so about the entire Asian emerging market complex. There's a tendency to compare this episode to the taper tantrum episode in 2013, but we don't think the volatilities would be as high as we had seen in that particular episode. And we don't think the pressure on the currencies, which are possibly the biggest drivers of equities in times like these, the pressures on the currencies, the Asian currencies, would not be as depressive as we had seen in 2013. There are a couple of reasons behind that. Number one, the country balance sheets in terms of their current account deficits and in terms of the forex reserves that these economies have are way more healthy than we had seen about 8 years ago. Second, when one looks at the balance sheets of the corporates which are participating, the average debt to equity ratio is far lower than we had seen at that point of time. At the same time, even this particular round of Fed tightening had actually been well telegraphed. It had been talked about. It had been discussed incessantly by various different market participants and the governors of the Fed, unlike the episode in 2013, which came as a surprise to the market. So, yes, I mean, we have to live with short-term volatility, but we don't really expect the kind of currency turmoil that we had seen in the past during previous episodes.
But Manishi, what explains the excruciating tech sell-off? I mean, even globally, if you look at it, the Nasdaq, for instance, excluding yesterday's rebound, is down 12% on a year-to-date basis as well. I mean, even back home, be it Zomato, Paytm, Nykaa, all these stocks have hit fresh lows for themselves. Some of them, like a Paytm and card trade, are already quoting 50% below their issue price. What explains this? Synchronized tech sell-off that you're seeing across world markets? I mean, are they falling under their own weight, or is there some other reason behind this?
Synchronized is the word that you very rightly use. And I think this synchronized sell-off, in a sense, explains that the reason behind this sell-off is also possibly the same across different markets. Whenever we have the likelihood of interest rates rising and therefore the likelihood of cost of equity rising across all markets, the valuations, which are essentially the discounted discounted present value of the cash flows that are going to accrue from these companies, these valuations tend to decline. Now, for the companies that we're discussing now, these tech companies, majority of their valuation actually is in the terminal value, because in the short term, they're not really likely to generate any kind of cash. These valuations, where a majority of the value is in the terminal value, they tend to suffer more when there's a risk of cost of equity increasing. And that's a universal truth. It's just a simple arithmetic that we have to live with. So it's no surprise that when there's a possibility, when there's an expectation of very sharp rise in cost of equity, it's these companies that don't have near-term valuation support, they tend to suffer more. And that's something that we are seeing across the world today.
The other thing, Manishi, is where are these pools of funds going to move to? Because, there's clearly a risk-off sentiment which is on. It's not just equities, but other fancied asset classes like Bitcoin as well as seeing a big sell-off. I mean, what's been holding out is only crude and gold. So where is the money going to move then, if not equities and Bitcoin?
With the equities, there could be pockets where the money could move into. If you look at some of the indices, which are the so-called value indices, like the Russell 2000, they have actually outperformed the growth stocks, like the tech indices, and outperformed quite handsomely over the last 1 to 1.5 months. In times like these, when valuation or lack of valuation support becomes a concern, investors tend to look at those companies that do have valuation support and at the same time do have some, especially in emerging markets like India, do have some growth story attached to them. So if we are able to find that sweet spot, then we could actually identify a few pockets. In fact, I would say in case of India, quite a few pockets where money could still move into. In a sense, we are actually seeing that not so much from the foreign investor side, but possibly from the domestic investor side. And in markets like India, there's a degree of support, a degree of neutralization of this FII outflow that is coming in from the domestic investors. I would say that we are living in a world of very heightened, very increased degree of volatility. But once we're past this, I think investors would begin to look at those sectors which offer valuation support, and at the same time, a degree of a growth story being attached to them going forward.
Manishi, so what is in store for 2021? Is it about protecting gains or is it about buying risk? When you see moments like these in a bull market, you always look back and say, oh, I wish I would have bought the panic. Is this panic an indication that cycles are reversing, or this is a panic or a sell-off which we will look back 6 months from now or perhaps a year from now and call it as one of the best buying moments of 2022?
So this year, in 2022 as a whole, for emerging markets would possibly, and our prediction is that it would possibly be a flattish year. Within emerging markets, we expect Asia to outperform. We think Asian corporate balance sheets, Asian stability of earnings estimates, these are better than other pockets, other emerging market pockets like Latin America. And within Asian emerging markets, we think that India and a few other markets like China or Korea would outperform. And therefore, we have overweight stances on these markets. Now, having said this, I must also point out that for, let's say, the Indian market, this would clearly not be a year as strong as 2021 or 2020. I mean, we have seen, if my memory serves me right, possibly 3 years of very strong returns from Indian equities as a whole. So the fourth year in succession would possibly not be as strong. I would expect returns from the Asian markets in the range of about 7 to 8%, possibly a little higher from the Indian market, which is actually encapsulated in the kind of Sensex target we have, 62,000 compared to, correct me if I'm wrong, it's about 56,000 now on the Sensex, which is about 10 to 11% up from here. Hindsight is always 2020. So we may actually, possibly a couple of months down the line, think that this downturn, this downward spike was the best time to buy. I think that for the long-term investor and someone who's consistently investing in the equity market, trying to time the equity market is really difficult. I mean, it doesn't really, hold. It doesn't really, possibly give a significant dividend to investors over a long-term basis. So for longer-term investors, it is important to look at quality stocks which have the degree of valuation support and a certain degree of growth story over the next few years, and possibly stagger their buying momentum, stagger the quantum of money that they want to invest over a certain period of time. There are sectors available. Banks are one of them. IT services are one of them. I highlighted these two as having increased, having had an increase in their earnings estimates over. We are also positive on select consumer discretionaries in the auto universe. Conglomerates in energy, possibly in the TMT sector, also fit the bill.
Always a pleasure to have you on ET Now. Thank you for joining us.